Now, I had a couple of questions regarding this one. You remember this one? So this is from chapter 2, okay? So this is from chapter 2. And we actually, I remember this time. So this is from chapter 2, and I received a couple of questions regarding that. You guys remember this one? Anyone try to solve it? Tom? No? Or no answers? Again, no answers. Okay. So basically, this is where you will be asked to make certain corrections where the trial balance will actually balance. However, there will be some mistakes here, and you're expected to fix it. Okay? So for example, you have here the first one. The totals of debit sides of prepaid insurance, accounts payable, and utilities expense were each understated by 100. I personally find it easiest to do it this way. You write each one of them and the balance that you have. So here, what's the balance that we have? We start with prepaid insurance. What was the balance? Come on, you can read it.
700.
So, prepaid insurance. It was a debit balance of 700. And the problem says that it was understated by 100. So you add 100 to the debit side. What's the new balance? 800 on the debit side. Look at the second one, accounts payable. We have accounts payable. What's the balance of accounts payable? Come on, faster. You can read. I know that you can read.
4,500.
4,500 on the credit side. So it's a credit balance of 4,500. The debit side was understated. So you add the 100 on the debit side. The reason why I'm saying that I'm using here T accounts is simply because if you just look at it and you add 100 to each balance, at that time you might end up with a balance of 4,600 instead of the 4,400 for accounts payable. Do you understand the point here? Okay. Now, for example, when you look at problems like when you look at corrections like number 4 here, what does it say? It's $100 cash dividend was debited to common stock for 1,000 and credited to cash for 1,000. Now, what's the correct journal entry for $1,000 cash? So, as far as we are concerned, this is the correct transaction. What do you do here? What's the journal entry for $1,000 cash dividend? Yes.
Instead of crediting common stock, you would debit dividends.
Yeah, but just that's correct actually. But so what do? You debit dividend and you credit cash. So the correct one is 2. Debit dividend 1,000, credit cash 1,000. What was the entry that they made and that was incorrect? They debited what? Common stock 1,000. They credited cash 1,000. There are different ways of doing that. This is correcting. This is the correcting entry that you can do it in one of 2 ways. You can either cancel the incorrect one and re-enter the correct one. At this stage, I advise you to do that. Or you can just do it directly and correct only, for example, common stock. How do you cancel a certain transaction? How do you cancel one like this? You enter the opposite.
Oh.
Yes, sorry, go ahead.
No, I was just gonna say you would then credit common stock for $1,000.
Exactly. So in order to, if you want to correct a certain entry, common stock was debited $1,000, you want to cancel that one, you credit $1,000. So what do you do here? In order to fix it, this is what you need to do. Credit cash 1,000, debit cash 1,000, credit common stock 1,000. Those two will cancel each other. This one will cancel this one, right? It will basically offset the incorrect one, and then you re-enter the correct one here. So in this case, what do we have? How do you now fix the balance? Let's go back to cash. We had cash. It had the balance of 3,850. What did we do here? And what did we do? We debited cash 1,000, right? And then we credited cash 1,000. Let's look at common stock. Common stock had a balance of 11,700. The credit balance of 11,700. What did we do? What did we do to correct the mistake? Remember, this one was already done. So we did not do anything here. This is the correcting one. This is to offset the mistake. And this is the correct one. So now, which one did we actually enter as far as common stock is concerned? Jason, right? Originally was already in, so the original one, this one, is included in the trial balance. Already included in the trial balance. Exactly. So what you need to do is actually this one. This is what we did. We credit 1,000. Now what's the new balance? That's not very hard. What's the new balance? 12,700. Thanks, Laura. Any questions about that? So I'm not going to continue the whole thing, but this is just to give you an idea because I received a couple of questions about this and how to do it. This is how you do that. Do it step by step. Don't try to rush into basically coming up with a correct balance. Do it one step at a time. And the easiest way is to do it using T account. You enter the correct entry, you make the correct entry, and then use also the one, basically you do the one that offsets the incorrect entry, and then you include the new one. Okay? Now we can continue with our lecture, right? So what did we talk about? We were talking about adjusting entries, right? Remember adjusting entries? Do you remember adjusting entries? We said that adjusting entries are important. Why? Because they will update trial balance. The information in the unadjusted trial balance, the information is most of the time out of date, right? So in order to bring it up to date, we have to make certain adjusting entries. And we said that there are two types of adjusting entries. We have adjusting entries for deferrals and accruals. So you have deferrals and accruals. Deferrals are transactions where cash was exchanged in advance. Whether the company paid in advance for a certain service that they will receive in the future, that would be prepaid expense, like insurance policy, remember that? Prepaid rent. On the other hand, you also have unearned revenue. is where the company received cash for services that they will provide in the future. So they have not earned them yet. We talked about different types of deferrals. We got actually to depreciation. And we said about depreciation, that depreciation is actually not evaluation method. We're not re-evaluating the value, we're not actually re-evaluating the asset. We're not trying to see how much the asset actually is worth today in the market. That's not what we're doing. We're simply saying, depreciation, think of it this way. You bought a truck for $100,000, you expect it to work for 5 years, that would, generally speaking, that would say that, okay, so those $100,000 must be split over the 5 years. How we split them, we will learn later on, but the simplest way is when you divide it up by the year. So at that time, you have every year, you have an expense for that truck for the value of $20,000. Okay? So this is what we mean by depreciation. It's simply splitting the cost of an asset, usually like a building, a truck, a machine, etc. You're splitting the cost over the useful life of that asset. Useful life is how long you expect it to be used for. Okay? And now if you remember, we said that instead of using the asset like we did with supplies, for example, we debited supplies expense, we credited supplies, right? Here we cannot credit the asset directly because those assets must be recorded as cost, and the cost principle, the historical cost principle, requires us to keep reporting that asset at cost, right? It's called historical cost, hence cost principle, so it has to be recorded every time, every year, at the same value. Now, how do you say that you used already part of that truck? You are still reporting under assets that you have a truck that the cost of that truck or the value of that truck is $100,000. So how do you convey the message that you already used part of it? And it's not like use part of it, it's not the cake where you can eat half of it. It's basically used up, it's used up now, it's older than before, it has certain miles and stuff like that. So how do you convey that message? By saying that I have accumulated depreciation. Okay? So this is the expense that will accumulate. And this is the contra asset account. And contra asset accounts, what do they mean? They are subtracted from the value of that asset to get to what we call the book value. The book value is how much the company considers that this equipment is worth according to their books. It has nothing to do with the market value. Do not get those two things mistaken. Okay? And as you remember here, I'm doing that quickly because basically we went through that before. We covered this. So you debit depreciation expense, you credit accumulated depreciation. Okay? This is the adjusting entry. This is to adjust for that entry. This is actually what we're doing here is we are recognizing the part of that truck that we have spent or we have used. This is why it's depreciation expense. We are recognizing that expense that was associated with the revenues of that year. Okay? And as you can see here, we did not make any changes to equipment, but we did add it on the credit side. So you see, accumulated depreciation is a contra asset account. As a result, it has an opposite normal balance than that of the asset. Assets usually have normal debit balance, so contra assets will have a normal credit balance. Okay, and the way it looks like on the statement, this is how it would look like. Blurry. Okay, now it's better. So how does it look? What do you have? you would have, you remember we have assets, right? We will be listing the assets. You have, for example, cash, accounts receivable, equipment, and then immediately after that asset, you include its contra asset. So you have equipment less accumulated depreciation for equipment. Okay? The two together will give you the book value. This is what we call the book value. And the book value is basically what? This is according to the company's books. The part that is remained in the asset and not spent. The part that we have not converted to expense. Okay? So this is not the market value, it's the book value. Whenever you want to calculate the book value is simply the difference between. So it's simply the value of the asset at cost minus accumulated depreciation. So the asset minus accumulated depreciation will be equal to book value. Any questions? Now, this is a summary of how we account for prepaid expenses. So prepaid expenses will be, how do we do that? We know that with prepaid expenses, what did the company do? The company paid in advance for a service that they will receive in the future. As a result, the company, however, this is for prepaid expenses. By the end of the month, they use part of it. Remember, like the insurance. Company paid for 12 months. By the end of the month, company used up 1 month. So 1 month of that prepaid expense has expired. So what do we need to do? We need to decrease our prepaid expense, this asset, we need to decrease it by this month. Prepaid interest will decrease by 1 month, and interest expense will be recognized for 1 month. So what do we do? When you want to decrease an asset, you wake up first, and then you credit the assets or the contra assets, so it depends. And to increase your expenses, you debit the expense. So whenever, to simplify it, whenever you need to make an adjusting entry for prepaid expenses, you debit the expense, you credit the asset or the contra assets. Before that, our asset was overstated. Before making the adjusting entry, we said that we had 12 months worth of insurance policy. At the same time, we said we hadn't recognized any expenses as interest expense. So our expenses were understated. We'll fix that. Any questions? Unearned revenue, like we mentioned the other day, it's the other way around. This is where the company received cash for services that they have not provided yet. And as you remember, we also said that one company's unearned revenues is actually another company's prepaid expenses. When the company, you remember the example about the 3 billboards? One company paid it in advance, the other company received the money in advance. Rent. One company paid rent in advance, that was prepaid rent. As far as the landlord is concerned, the landlord received cash before providing the service, which is location for rent. That would be, in this case, an unearned revenue. Okay? Airline tickets is the same thing. If the company buys airline tickets but do not use them now, that will be prepaid expenses. If the airline company sells you tickets, sells the company tickets or sells you tickets, that's unearned revenue because they have not provided you with the service. Any questions? So now how do we do that? Unearned revenues. When you have unearned revenues, what do we have? You have, at the beginning of the month, you said that, for example, let's say 3 billboards. The company hadn't earned any of it. But by the end of the month, they earned part of it. So part of the unearned revenue was earned. And when you say that it's earned revenue, what do you call it? What's the account that we call it? Yes. Revenue. Simple. So what we need to do is we need to increase revenues. And what's the other account that, so how do you increase revenues? By crediting them, right? Increase revenue by crediting revenue. So what's the account that we need to debit? We need to debit? Sorry? See, it's not the liability, right? Unearned service revenue. So basically what you're saying is that part of the unearned revenue, now we earned it. So you decrease unearned revenue, you increase revenue. How do you decrease the liability? You debit liability. You credit revenue to increase. So for example here, Pioneer Advertising Agency received $1,200 on October 2nd from Arnavs for advertising services expected to be completed by December 31st. Unearned service revenue shows a balance of $1,200 in October 31st trial balance. Yeah, I'm busy. Yes. Seriously? After I went through all that quickly, now you want me to go back to the slide? Okay. It's okay. It's okay. Go ahead.
So you said that you accredited revenue, but then you also said that you were debiting revenue also.
No, I'm debiting unearned revenue. Unearned revenue is a liability. So remember, unearned revenue is basically an obligation that the company has. The company receives cash in return for services that they will provide later on. Now the company has a new obligation, a service. That service, let's say it's unearned service revenue, that service has to be provided in the future, so that's a liability. It's an obligation. Now, your obligation has decreased. When liabilities decrease, we debit that. That's the only thing. So you debit the liability, which is called unearned revenue. Okay, so you debit unearned revenue and you credit revenue. Okay? Now, I'm not going to repeat what I read before, so I'm going to jump directly to that one. Now, what's the journal entry that we need to do here? So the company performed $400 of the service. The original amount of unearned service revenue was how much? 1,200, right? Out of these 1,200, by the end of the month, the company earned 400. So what do? You have to decrease, yes, right? You have to decrease unearned revenue by 400 and increase service revenue by 400. Basically, you're saying that out of these $1,200, I earned 400. You have to recognize it, but you're not receiving cash. Why cash is not involved in this journal entry?
Because you already got it.
You already received it before. You already got the cash the first time they paid you, even before performing all these services. So what you do here is you debit unearned service revenue, you credit revenue. Okay? So when it comes to unearned revenue, it's easy. You debit unearned revenue, you credit revenue. Any questions? So this is the same thing that we just said. And then you post them, of course, you always post them. As you can see, you always put here the basically adjustment. You write adjustment so that it would remind you that that was not a regular entry, that was an adjusting entry. To distinguish between this one and a totally new transaction. Okay? So this is how we deal with unearned revenues. We debit the liability, which is unearned revenue, we credit revenue. This is how we adjust for the earned part of unearned revenue. Any questions? So now, when we would need to adjust for prepaid expenses, what do? We debit the expense, we credit the asset. asset or the contra asset, right? When we are adjusting for unearned revenues, what do? The adjusting entry would include a debit to unearned revenue, a credit to revenue. Any questions?
$6,000 a box.
That
That's not bad.
no, we're here to live in
Not bad at all.
good.
So this is a typical question from the exam.
I guess I'm gonna pass.
Okay, so this is a typical question from the exam. Okay? You will be given a statement like this, and you will be asked to tell which is the correct entry. In this case, it's an adjusting entry. It could be a correcting entry, a closing entry, a regular general entry, so it depends. This is why it's very important to understand which accounts to credit, which accounts to debit, and when, etc. Okay? So in this case, we have the company received a check for $18,000, which represents a 6-month advance payment. So what's this transaction?
Unearned rent.
Sorry?
So-
Imran, right?
Yeah.
Okay,
You
so
get $18,000
$18,000
of cash for
Cash.
unearned rent.
for rent. So this is the original entry. Here they didn't ask us for it, but it's important to understand that this was for prepaid. No, this is for the company received the cash. So it's unearned rent revenue, right? We know here it's unearned rent revenue for 18,000. So it's 18,000 for 6 months. So how much is it per month?
3,000.
3,000 per month. Unearned rent was credited for the full amount. Financial statement will be prepared at the end of the month. So the company will need to adjust for the month of July. So we have 1 month, and whenever we need to adjust for unearned revenues, what do? We decrease unearned revenue, we increase revenue. How do you decrease unearned revenue?
You debit it.
We debit. So the thing is to debit unearned rent revenue and to credit rent revenue. Okay? Anyone has an issue with this one? Before we move on. You can either, if you want, if you feel more comfortable memorizing that in cases of unearned revenue, you simply debit this account, credit this account, I'm fine with that. This is up to you. If you simply prefer to understand the concept, in this case it would be easier in my opinion. For example, you remember that, okay, so what do you need to do? You earn part of this unearned revenue will have to decrease. How does the liability decrease? By debiting that liability. So we debit unearned rent revenue, and we earn part of it, so our revenues have increased, rent will be credited. Okay? So the ledger of Hammond Inc. on March 31st includes these selected accounts before adjusting entries are prepared. So that's the trial. Thank you. So that's the trial balance. Okay? It's not the complete trial balance, those are like the balances for certain accounts. Now, an analysis of the accounts show the following. Insurance expires at the rate of $100 per month. We need to prepare the adjusting entry for each one of them. How do you adjust for insurance? So when you have insurance, it is prepaid insurance, right? When you have prepaid expense, how do we adjust for it? Sorry?
Credit the prepaid insurance for $100 and debit insurance expense for $100.
Yes. What do you need to do? You need to recognize that expense. You need to decrease that asset. So you credit the asset, you debit the expense. So you debit insurance expense, you credit prepaid insurance. Next, supplies on hand total $800. So what was the supplies that were used?
2,000, 3,000.
Sorry?
2,000.
2,000. So the company used $2,000 of supplies. They spent $2,000. So what do?
Right?
You debit supplies, expense, credit, supplies. You debit the expense, you credit the assets. The equipment depreciates $200 a month. This is what I meant earlier. You will be given the amount of depreciation at this point. Later on, you will have to learn how to actually calculate it. But for now, it says that $200, basically the depreciation is $200 per month. What do? Yes?
You credit equipment for $2,200 and then you debit $200 for equipment expense.
Partially, not equipment, depreciation expense.
Depreciation.
Partially correct. So you debit depreciation expense, yes, and you credit equipment. We cannot credit equipment directly unless you are actually throwing away the truck. Remember the cost principle. What do you use? Accumulated depreciation. So this is where you use accumulated depreciation. You will be debiting depreciation expense and you credit accumulated depreciation equipment. The last one is 1/2 of the unearned service revenue was recognized in March. Company earned half of the unearned revenues. Right? So what do? Debit unearned revenue and credit service revenue. That's not too difficult, right? I expect you guys to do well on these in the exam. You need to practice a little bit. That's what the homework is for. And Orion also is very helpful, I think, in these cases. If you want, how many of you use Orion? Again, it's not required, but it's very, very, very useful. Okay. Now we get to adjusting entries for accruals. Accruals are expenses or revenues that have accrued. What do we mean by accrued? They have accumulated. Remember the example about the salary? Clifford is very excited. I'm not sure about what. Definitely not accounting.
No, it actually was.
What a nerd.
Because you said, I was so happy because you said accumulated. And that was the exact word that I was thinking.
Okay. So he wasn't a nerd, he was basically just smart. So I'll give him a smiley face. Good? Are we even now? Okay. So basically, yes, it's true. So when you have, this is whatever revenues have accumulated, but the company cannot recognize them because their client will not pay them until the whole job is done. If this is, for example, if you are fixing parts, let's say that you are fixing a machine, you fix part of it. It has two problems. You fix part of it, and then but the client will not pay you until the whole job is done. Remember, again, the accrued revenues. Another example is where you have, you remember the billboard example? This is in case the client will not pay. So if the client pays in advance, then it's what? Unearned revenue. But what if the client does not pay you now and will not pay you until you finish posting the 3 billboards? What happens? Did you receive cash? Were you paid? So at the beginning you do not recognize anything, but at the end of the month you already put up 1 board. Did you earn any of that money?
Yeah.
You did earn part of it, although you haven't received money. So this is an example of accrued revenue. To me, let's say that I was a company and my salary or the amount of money that I am expecting from regulars for the last few days between, let's say I get my last paycheck on September 26th. Between 26th and the end of the month, those days I will accumulate certain revenues that regulars will not pay me. until November. However, did I earn that money? So accrued revenues, basically, they account for the revenues that have accumulated until the day the statements are prepared. So for example, the company is going to prepare the statements on September 30th. So until September 30th, how much did I earn? Regardless of whether I received the cash or not. Accrued expenses is the other way around. I owe money to my employees. Regulars will owe me money. So regulars will have to actually wait, they will actually have to recognize those expenses even though they're not going to pay me until next month. But still, they have to recognize that money. Now it's an obligation. They have to recognize that expense. This is what we mean by accrued expenses. And actually, accrued expenses and accrued revenues, I think personally that accounting for them is slightly easier because at this time, before the adjusting entry for accrued revenues, you have not recognized any revenues, so your revenues were understated, and you have not received any assets in return, whether cash or accounts receivable. So what is it? Your assets are also understated. Okay? So what do you need to do? You need to increase both of them. How do you increase assets? You debit assets. How do you increase revenue? Credit that revenue. Okay? A popular example actually in the book that they keep giving is interest. This is especially when companies do not make an adjustment after every transaction. No company would actually, it's not efficient for any company to keep making adjustments every day for interest. They wait until the end of the month and they do that. It's not like, it's same thing with salaries, for example. They're not going to count salaries every day unless the employees are paid by, like, they are daily employees. But in general, if they have salaries, monthly salaries or bi-weekly salaries, they will wait until the time of the payment, or they will wait until the time of the trial balance of the statement preparation to do the adjusting entry. So here, on the day that the statements are prepared, say the end of the month, company will recognize the revenue. But because the company will not be paid, remember, the company will not be paid in cash until the whole service is done. If the whole service was done, then you have no problem. You don't have any accrued revenues. You have a revenue that you provided for, basically a service that you provided for cash. This is what it means. Okay? So how do we do the adjusting entry? Pioneer Advertising Agency performed services worth $200 that were not billed to clients in October. This is part of a bigger deal where the company will pay everything, where the client will pay everything in December, for example. However, the company earned $200 in October. So what do? They earned it. When you hear the word earn something, this is revenue. So the company earned, we know that revenues have increased by 200. Did the company get paid? The company receive cash. When they don't receive cash, what do you call it?
Accounts receivable.
Accounts receivable. We know that accounts receivable also increased by 200. How do you increase accounts receivable? You debit accounts receivable, 200. You credit service revenue, 200. So to adjust for accrued revenue, you debit accounts receivable, you credit revenue. Okay, now on November 10th, the company received cash. What are the accounts that are involved? Cash and? Cash and?
Accounts receivable.
Exactly. So cash and accounts receivable. There are no new revenues here. The company is simply receiving money, basically that their clients owe them. Their clients owe them 200. Company will pay that the client pays that money. So the company will debit cash and credit accounts receivable. Any questions? So here what happens is that the company will receive cash, so their cash increased. What do they receive it in return for? This is in exchange for the IOU slip that they had received from their clients. The money that they expected to get from their client, they don't expect it anymore. They don't expect to receive it, so accounts receivable will decrease. And this is basically the journal entry. So when we account for accrued revenues, we need to increase both the assets and the revenue. So we debit asset, we credit revenue. Accrued expenses is the other way around. Those are the salaries that the company hasn't paid yet. For example, interest that the company owes, but they are not going to pay now. And it happens before cash payments, before cash exchange. Remember, prepaid expenses, unearned revenues, cash is exchanged before the event, basically before the service is provided. Okay? Here, with accrued expenses and accrued revenues, cash payment is actually done after. The cash payment is done after the expense or the revenue are recognized. So in this case, what do we need to do? Accrued expense. You're saying, before that, you're saying that you did not recognize the fact that you owed your employees' salaries. So now, you have to recognize that you have more salaries that are owed, and this is salaries expense. So what actually happens is that you're saying, okay, on the 30th of September, Rutgers will say, I owe Hussein $200 for the extra days that he worked here. I'm not going to pay him that money now. So this is salaries and wages payable, because they are not going to pay me on that day. Right? This is salaries and wages payable. It's a liability. As far as Rutgers is concerned, this is an expense that they have to match with the revenues from September. So they have to recognize the expense in September. Why? When did I provide the service? When did I teach? In September. So they have to actually recognize it in September. As a result, it will be an expense recognized in September, but because you are not going to pay me, it will be here, a debit. The expense, debit to, for example, salaries, expense, right? To recognize it, and a credit to salaries and wages payable. This is the increase. Okay? So, we go back to the example of interest. Pioneer Advertising Agency signed a 3-month note payable in the amount of $5,000 on October 1st. The note requires Pioneer to pay interest at an annual rate of 12%. How do you calculate interest? You always calculate interest using 3 values, 3 amounts. You have the face value. The face value is the value of the note itself. In this case, it's $5,000. You have the face value. You multiply it by the annual interest rate, and then you multiply it by the number of months, or basically the period of that year. So in this case, it's 1 month. This is why you have 1/12. If it were for 3 months, what would it be? 3/12. Something like that. So it depends. Later on we will learn more about interest. But in this case, you have those 3 amounts. The face value, this is the value of the note payable itself. And then we have the annual interest rate. And then how many months in that we are actually counting for. That's easy, right? So in this case, we know that the interest is $50 per month. So it's $50 per month. Every month, the company will have to recognize interest. You see, in this case, they signed that money in, they signed that note in October. Bless you. There's something that we will learn later on. Notes payable are usually, the interest for notes payable are usually paid either at maturity. They are paid at maturity. Basically, when do you mean, what, like in this case, it's 3 months. So the amount will be paid. The full interest amount for 3 months will be paid
At the end,
at the end of
the 3 months.
the 3 months. This is what we call maturity. So at maturity, it will be paid. Okay? In this case, it's not going to be paid now. It's going to be paid in 3 months. As a result, the company is not going to pay anything yet. However, they still have to recognize the interest expense that has accrued. So interest expense has accrued, has accumulated. So that Clifford will be happier. Accumulated. Okay? What do you do? What's the adjusting entry? At the end of the month, what's the adjusting entry? Yes. You debit interest expense 50. What do you credit? Did the company pay it in cash? We said that the company is not going to pay it until the end of the 3 months. Interest paid. Now, the company does not credit it directly to notes payable. Why is that? Because the company would like to keep separate the interest expense or the interest that they are accumulating or they're paying from the principal. The principal is the $5,000. This is the original amount of the loan. They separate the original amount of the loan with the interest amount. And those are different. So they separate them. So to adjust for accrued interest expense, we debit interest expense, we credit interest payable. Any questions? Later on, when the company receives cash, they will debit cash and they will credit interest payable. Right? Right? See you later on. Now what are we doing? Remember, the company is not going to receive cash. The company is going to pay cash. You have to be careful about that. Payable. If you credit interest payable, it will increase. Don't just tell me yes. I will be asking you some tricky questions. Don't say just yes. Think about it before you answer me. When the company, after 3 months, the company will not receive cash. The company will pay cash. They will pay the debt. When they pay their debt, what happens to their liability, interest payable? It will decrease. What happens to their cash? Decrease. So when cash decreases, what do? You credit cash and you debit interest payable. Company is not receiving cash for interest. They are paying that interest. Don't just okay me or don't just say yes to me. Think about it. Now, any questions about this? The other example is salary. We did that basically, we've been talking about that for the past few days. Pioneer pays salaries and wages on October 26. The next payment of salaries will not occur until November 9. The employees receive total salaries of $2,000 for a 5-day work week or $400 per day. So the accrued salaries are for 3 days. Multiplied by $400 per day, that's $1,200. This is the amount of money that the company owes their employees. They're not going to pay it. So the company owes their employees. What's the adjusting entry that you need to make? The company owes their employees. Yes. Salaries payable and salaries expense. So what happens? They are recognizing an expense. Just to mean their expense is when you recognize an expense, your expense increases. So what do? You debit salaries, expense, and what do?
You credit with
You credit the liability, salaries and wages payable. So the thing here is that the company recognizes the expense without paying it. They have no more liabilities. They have a new obligation, which is called salaries and wages payable, for the value of $1,200. Any questions? Okay. As you can see, when we account for accrued expenses, we need to increase expenses, we need to increase our liabilities, right? How do you increase expenses? We debit expense, we credit the liability. Any questions about that, or we're fine? So Microcomputer Services Inc. began operations on August 1st. At the end of August, anyway, so management attempted to prepare monthly financial statements, and the value information relates to August 1st, blah, blah, blah. Prepare the adjusting entry August 31st. So the company owed its employees $800 in salaries and wages that will be paid on September 1st. Think about it for a minute. So on August 31st, company, they owe their employees salaries, and they have to debit salaries and wages expense, credit salaries and wages, pay. Okay? On August 1st, the company borrowed $30,000 from a local bank on a 15-year mortgage. The annual interest rate is 10%.
a year.
First of all, you need to calculate what? Interest, the interest amount. What's the interest amount?
10%.
Sorry?
30,000.
I'm not Superman. I cannot hear you when you're just whispering from up there. Yes? So, okay, so it's 3,000, it's 30,000 multiplied by 10%, 3,000, right? This is per year. That's the annual interest rate. Then, how many months are we counting now? 1. So you multiply it by 1/12, right? So basically what we need to do here is first throw this pen away. If you thought that my handwriting was bad, wait now. Wait until you see it now. So it's 30. Yeah, I'm not gonna do that. You guys write it down. Tell you what.
How do you take it? 30,000 times 10%. It's 15.
Where's the fun in typing?
Times 100.
Okay, that's nice.
Still makes smiley faces.
You really want to see a smiley face with this one? It will be all distorted. So basically what you have here is 30,000 multiplied by 10% multiplied by 1/12. So that would be 250. Okay? So we have $250 per month. This is the value of the interest that accumulates every month. So this is the accrued interest, right? In this case, this is interest expense.
Yeah.
You debit interest expense, you credit interest payable, because remember the company is not going to pay it now. So this will be interest payable. Last one is revenues for services performed but unrecorded for August totaled $1,100. When you say that they are unrecorded, what do you mean by that? They are accrued revenues, right? How do you recognize accrued revenues? How do you adjust for accrued revenues? Yes, sorry? So you credit the revenue to increase revenue, and you debit an asset. In this case, which asset specifically? Accounts receivable, because the company did not receive the cash. So it's accounts receivable is debited 1,100.
I was on the other side.
Service revenue is credited 1,100. Any questions? Okay. So this is a summary for when we have prepaid expenses. The accounts before adjustment. We have assets are overstated and expenses are understated, because you still say that, for example, you have 12 months of insurance. Still haven't recognized the 1 month insurance expense, that basically the insurance for 1 month. How do you do that? You need to decrease assets, so we credit assets and we debit expenses. If it's equipment or anything depreciable, we use accumulated depreciation. We use the contra assets. When we have unearned revenues, we have liabilities are overstated and revenues are understated. So what do? You need to recognize the revenue and say that now we have less unearned revenue. What do? You debit the liability and you credit revenue. Accrued revenues, you have both assets and revenues are understated. You need to increase both. You debit assets and you credit revenues. Accrued expenses is where you have liabilities and expenses are understated. You need to increase both of them. So you debit expenses, you credit liabilities. Any questions? Okay. Now, once we're done with that, we prepare an adjusted trial balance. So the adjusted trial balance is very similar to the trial balance, simply it includes the new adjusted values. Okay? This is done after all. This is done after all. We do that after all the adjusting entries are recorded. Once again, this should prove the equality of debits and credits of the adjusted values. And usually this is what the companies use to prepare their financial statements. Okay? We'll do that next week. This is how, the general journal looks like when you're entering adjusting entries. Okay, you have all the adjusting entries, those are exactly the ones that you used. And then after that, you enter this information in the ledger. You post them to the ledger. As you can see here, you have a header that basically is called adjusting entries. This is to explain that this entry came from those adjustments. As you can see, the date is always the end of the month, the end of the accounting period. Okay? Any questions? Once you have this one, you prepare the adjusting entry, the adjusted trial balance. That's the balances, those are the balances that will be used for the preparation of the income statement and the balance sheets. How is that done? Well, let's do this one first.